Hopefully I'm not forgetting anything, so I'll turn it over to you, Linda. Enjoy your class.
Thank you, Susan. Now let's see, we'll share a screen here. Since I'm considered such a technical genius, we'll share the screen here. Susan overstated things there a bit, but here we go. Now,
I will tell you, Linda is working with 2 screens right now. So when she looks up, she's actually seeing the whole class on a big projection monitor. And it's pretty amazing, honestly, that she is doing it because it's next level tech. So
now today, now you all see the PowerPoint screen, correct?
yes.
Yes, okay. We're going to speed ahead to where we left off last week on this PowerPoint. And let's see.
Linda, there is one thing, is go back and unshare your screen. And remember how there are 2 options to choose the PowerPoint. One is your desktop, and then the other is beneath that. So now go back to share screen. And then when you choose the icon, make sure it's the one in the second row that has that's just the PowerPoint.
Right here. Yep.
So now go in the lower right-hand corner and click this share. Ah, perfect. Great job.
All right. Now, let's see. I'm trying to go down on I'm trying to take
advance it. So you're going to want to take your cursor and drag it onto your PowerPoint on the first screen. And now you can, I think you can just click or tap your touchpad, should advance it. And then you can use your left and right arrows to go back and forth.
It's not working.
Okay, give me 1 second.
Okay. All right. While we see now, my reputation as a technical expert has crashed already. We've already had a crash today, and Susan is going to come in and fix everything. I wanted to touch back on where we came out at the end of the chapters we covered last week, and a couple of the, I think, okay, now it's ready to go. Okay, thank you. A couple of things I think we could realize from last week is that in a way, we can only see the beginning and the end of something in retrospect. And we only know what's prudent in retrospect. We don't know what we did that was so brilliant until after we see how it comes out. And frequently, alas, we don't realize our mistakes until after their consequences have been realized. So it introduces the idea that when we're dealing with looking at the economy or things that are good or bad news and how they're going to affect the economy or the stock market, it is a matter of guesswork, and it is tending to get us involved in a logical fallacy, which has a Latin name. It's so ancient that it has a Latin name, and some of you will realize when I give it the name. Post hoc ergo propter hoc is one of the classic logical fallacies taught in the Greek textbooks of logic. Post hoc ergo propter hoc is a fallacy. After this, therefore, because of this. And it gives rise to superstitions, and then it also can give rise to understanding cause and effect. But if I got up on the left side of my bed one morning and I failed the math test that day, I try getting up on the right side of the bed, and sure enough, I pass the test. Now I think I know that which side I get up on the bed from affects how I do on the test, and superstition arises like that. How do we know what it is that caused all those things that any newscaster who's talking about the market that day says caused it? They'll say the stock market lost 400 points today on news that, and then they'll give some piece of bad news that happened yesterday. How do we know that that's a cause-effect relationship? So when he starts, that's the point of writing history books, because we can see in retrospect the causes and effects and the relationships of things that we couldn't see when we lived through them. Now, as we go into the article on the crash, notice at the very beginning on page of this chapter that we're reading first, page 88, he starts that chapter out by saying, according to the accepted view of events, blah, blah, blah. Now, when somebody starts that way, according to the accepted view of this, it's da, 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 da. What do you expect after that? You expect the speaker to say, but here's how it really happened, or but here's how I see it. So is Galbraith doing that here? I think he has set up his chapter that way. According to the accepted view of events, by the autumn of 1929, the economy was well into a depression. And then he goes through several facts related to that. And then at the end of that paragraph, he says, a penetrating student of the economic behavior of this period has said that the market slump, quote, reflected in the main the change which was already apparent in the industrial situation. So he used the word reflected. And he's going to use the analogy mirror a couple of times here. So the market mirrors what already happened in the economy. And then he says, well, that's the accepted view. And now he's going to say, now I see it this other way. So he's raising the question of post hoc, propter hoc. What is it that caused what? Which came first, the chicken or the egg idea? Thus viewed, the stock market is only a mirror, which perhaps in this instance, somewhat belatedly, provides an image of the underlying or fundamental economic situation. Cause and effect run from the economy to the stock market, never the reverse. But Galbraith is saying that's the accepted view. That's what everybody thinks. But now I'm writing a whole book to tell you something else. In 1929, the economy was headed for trouble. Eventually, that trouble was violently reflected in Wall Street. In 1929, there were good or strategic reasons for this view, and it's easy to understand why it has become the high doctrine. Now, is he setting himself up as one of these scholars who says, oh, all the other scholars say this, but I have a new insight? So as we work through these chapters, we're asking ourselves, is Galbraith under falling in line with that idea that first the economy was in depression and then the stock market reflected it? Now, all of us have really reflected on this in the last year. How many of you, well, probably every senior in some way has a foot in the stock market through whatever funds we rely on for our so-called fixed incomes. Raise your hand if you know that you're directly or indirectly involved in the stock market. What happens in the markets will affect you. Okay, was that true in 1929 from what he said in the first two chapters? I think not. I think he emphasized at one point that the size of the population was 120 million. And yet there were only 1.5 million who directly or indirectly were in the markets. So, and then he said there were 30 or 40 million households. So even there, only 1.5 out of 20 million households were in the market. 1.5 out of 20 million would mean 1 out of 30 million, 1 out of every 30 households had a foot in the market. Well, we got more than 1 out of 30 in our population. And even if we took a young population of college students, many of them would realize that whatever money sent them to college was probably in part from their parents' savings or investments, or, were somehow had a relationship to the market.
Linda?
Yeah.
I noticed that Marilyn Wickens has her hand up, and I just wanted to remind people that Linda is accepting questions. So if you have a burning question at an appropriate time, you are able to unmute yourself and ask the question.
Thank you.
And then if you would like to put something into chat, it will be coming to only me, and I will either break in when appropriate or we'll wait to the end. So.
Good. I need this because I can't see all your faces. I can't see all your screens from what I'm looking at. So I need Susan to either speak right up, just unmute yourself and speak right up, or wave your hand at Susan. I rather have people just speak up. So Marilyn Wiggins, did you have a question?
No, I don't. Thank you.
Or maybe you were answering a question. All right, so many of us realize, and we did get a lot of hands going up with, do we realize that we do have a stake in the stock market as just a person? Let me just throw out a couple of other facts that could come into our discussion today. Number one, I read yesterday that with the Super Bowl, the very surprising Super Bowl last week, all the sites where number of the sites where you could bet on the Super Bowl crashed because of the heavy traffic. So people who were trying to place bets on Brady as an afterthought or something, were trying to change their bets or do their bets, were crashing out last week. And that the total betting on the Super Bowl was 3 times as heavy this year as it was last year. How many of you think that the Super Bowl bettors realize they're just having fun? Hey, they're just betting what they can afford to lose. They're having fun. It has nothing to do with serious investing, and they know it. How many, let's see a show of hands. Super Bowl betting, hey, innocent pastime. Most people are just doing it because of the office pool or for laughs or to talk to people about it. They're not betting the farm on the Super Bowl. That's how I feel. But I mean, I think that sports betting is an amazing world. And of course, since some of this betting has only been legal in Michigan for a year, Michiganders are probably having, a field day. And I think, as we mentioned last week, we do see an awful lot of advertising for just naked gambling on the televisions. People are just being lured into casual gambling, which is not quite the same as sports betting. But we're taking the idea that the stock market is not dealing primarily, not people who just have money to spare where they're trying to have a good time in the stock market and see what they can make happen. Does the health of the stock market depend on most of its participants being in there for the serious, real purposes that the market exists, which is to raise money for worthy companies? Or do you think, hey, it exists, it's a market. You don't try to judge who gets to go to a flea market or who gets to try to sell their wares. This is what we mean by a free market. Anybody who wants to sell anything they want can go into the street and try to sell it or buy it. And as long as certain rules that Congress has in place about fraud and so forth, a market is open. Anybody who wants, you're free to make a mistake. Let's go back to this question we raised at the beginning of this paragraph, though, to see whether Galbraith is saying that bad things happen in the economy, like the pandemic, and the stock market then should mirror it. Well, why didn't the stock market crash last year? How many of you expected the stock market to have a terrible, terrible time this past year because of the effect of the pandemic on the economy? Why would we not expect that? And yet, what happened?
The world is simply awash, absolutely floating in uninvested and difficult to invest money. It is there is such a surfeit of cash that is making low returns that there was almost no way for the market to stay down last year. If you're a hedge fund and you are responsible for investing 2 or 3 billion or $10 billion, you have to pour it into some place, and you can't hold it in cash because people will withdraw it from your fund. And so it was a foregone conclusion that when the market fell, it was going to come up with a roar. And I was not the least bit surprised to see it fly right past its previous high.
Good comment. All right, so George here is reasoning about the market based on something having to do with the market itself, the available money, where is it going to go, rather than the stock market will be a reliable mirror of anything that happens in the economy. Am I putting words in your mouth, George?
No, that's the reality is the market is an investment vehicle or tool availability. And if there is excess money to be invested, it goes into the market. And if there is a dearth of savings, then the money won't flow into the market. And when the United States decided to adopt $1 trillion program to help individuals, a huge amount of that money got saved because investors said, well, I have some money that I don't need. Thank you, Uncle Sam. And they put it in the marketplace.
All right.
And they made more money.
Okay.
And so we really, really created a whole bunch of new poor people and new rich people last year.
All right. That's a really profound comment, I think. And I think, George, would you say that what you're saying just now is in line with what Galbraith is saying overall in this book? That's why Galbraith is starting this chapter kind of questioning whether the market is a mirror of the economy directly. He's not buying the typical interpretation, and neither are you. You're pointing back to the market and the availability of money.
Money supply is as big a factor as anything.
Okay. Now, George just raised that last thing George raised was a kind of comment that the last year in the stock market, the rich got richer and the poor got poorer. Because the poorer segment of our population doesn't have any way to participate in the market. But we just saw that out of our population today of Hess people, just about everybody realizes that somehow they're connected to the market. Is that just because we're...
Linda, why don't you ask for a show of hands among the people that are here and that have significant IRAs, or independent of retirement savings money in the market? How many of them are down from a year ago and how many are up?
Okay, let's look at that. How many of you have such funds and you're up from a year ago? Okay, Susan, what do you see?
Well, every hand I could see was up.
All right. And George, you can see all the heads, can you?
No, I could, but because a lot of people have their video off, but I could see 10 or 15 and they all were up.
Okay. There's also a hand raise thing on your comments section. Okay, now how many of you are down? Who had a bad year in the stock market last year? Okay.
Did you stay out when you went out, or did you stay in?
You're muted. Unmute. Sue.
I stayed in, and I'm not sure why I lost some. Well, I had some bonds that were in the oil and gas things, and I bought them for $30,000, and they're down to $2,000 now. So I had about a $28,000 loss over the last.
No, well, you lost money on bonds. You didn't lose money on the stock market.
No,
the bond market took a hit.
Yeah, it was a bond fund, but it was in the oil and gas industry, and it actually was a well-known security, but obviously it just really tanked. So I kept them. I'm hoping that at some point they'll go back up. But anyway, so that was my major loss just in that one fund.
Mm-hmm. Okay. All right. But overall, the stock market was a big reward, and the bond market, which historically the gurus say bonds are safe and stocks are risky. How many of us have heard that in our lives, or we've gotten that general idea? A bond is safe and a stock is risky. I think many of us grew up with that idea. And I don't know how many of us, I'd like to see a show of hands again, maybe from last week, on how many of our parents in their generation did put money in the stock market with the hope of building their nest egg, that type of thing? And how many hands did we see here? Susan? I don't think I have any way of looking at all the participants. Does anybody have a gallery view on? Anyway, I think we would see half or a little bit more than half. I know that my own father was in his late 60s before he decided that maybe he needed to try to kickstart his retirement funds a little bit more. And so he would put several thousand into a stock and try to use judgment. And he thought, well, airlines should be good because that's a business of the future. And he lost some money in airlines. So he got kind of burned and he backed out again. And a little bit later, I knew someone in the 60s who had said to me, this was in the mid 60s, well, this Warren Buffett who's in Omaha is compounding money at a pretty good rate there. And Warren Buffett's going to be the guru of the future, this person said to me in 1965. So he knew our family and he tried to persuade my dad. A little bit later, mom and dad had some money in a savings and loan in South Holland, Illinois. And grandpa had helped start that thing, so he had some stock in there. But this friend thought that that savings and loan was going to be a bust, wasn't going to be any good. And would dad think about selling his savings and loan money and putting it into Berkshire Hathaway? And my dad said, no, I don't think so. It just sounds too risky to me. The savings and loan is the safe thing. And how many of you know what happened to that? So I don't know. It wasn't going to happen. And of course, he didn't think that this friend of the family knew what he was talking about. So it's all a question of who are you going to listen to when you suddenly have some money? And yet most people at some point in their lives are going to receive a bundle at once. Maybe you sell a house and there's some equity coming to you that you're not going to use for your next house, or something gets sold, or you inherit something. Or with my mother, her one and only rich uncle died and she got $8,000 at one time. And this was Uncle Henry's money. And she put it into a kind of a bank account. And you can't believe how many times Uncle Henry's money was spent. Every time she wanted something special that we couldn't afford, it would come out of Uncle Henry's money. And that's kind of how she used it. But she didn't think about investing Uncle Henry's money in the 60s. How many of you had something like that maybe in your parents' generation, where when they would receive something that just came like that, it didn't get invested? Maybe it got invested in a savings account. But it wasn't the idea that now I have a little tiny nest egg that I can put into the market and make it grow. Because I think what our generation can reflect is that our parents went through this whole period between the crash that ended in the 30s and supposedly brought or was accompanied by this terrible depression. And it was all related to something that happened on Wall Street, they thought. And so and stocks had crashed. So even if they didn't know anyone who directly lost money in the stock market in 1929, they didn't trust the stock market. And it took a very, very, very long time, as we said, for the stock market to get back to the levels that it had in 1929. As I said last week, it was 1951 before the stock market came back to the number that it had in 1928. And the same thing was true, I noticed, with the number of cars. In the year 1929, there were 5,300,000 cars manufactured that were sold. And they did not get car sales back to 5 million until 1953. With all that happened in the meantime, and the growth, tremendous growth in the population, that the car sales didn't come back up to 1953. So that gives us a picture of the era that our parents were in their middle ages and their senior years. I don't think there is a generation in the United States that has been more fortunate in what could have happened with the various nest eggs that were being built than people who came of age in the 60s and maybe a little bit later and are now, HASP members. How many would agree that from what you know about the different eras, that the generation that we belong to was more blessed by prosperity overall than our parents or grandparents, or maybe than any previous generation?
Absolutely. And I think too, our parents saw what happened in their own families. They saw how they got snake bit, how they were led almost exactly like Gilbreth put it in the book. As I was reading this, it almost followed paralleled what my mom and dad used to tell us kids stories about.
Yeah. Any other idea, any other contributions there? So as we read through here, we're going to be thinking, we're going to be questioning that idea that what happens in the economy, the stock market is a mirror. There are other ways to look at it, and Galbraith is pointing to those things all the way through. Looking at the middle of page 90, from the foregoing that he's just been through, it follows that the crash did not come, as some have suggested, because the market suddenly became aware that a serious depression was in the offering. A depression, serious or otherwise, could not be foreseen when the market fell. There is still the possibility that the downturn in the index frightened the speculators, led them to unload their stocks, and so punctured a bubble that had in any case had to be punctured one day. This is more plausible. Some people who were watching the indexes may have been persuaded by this intelligence to sell, and others may then have been encouraged to follow. This is not very important, for it is in the nature of a speculative boom that almost anything can collapse it. Anything can come along and puncture a bubble. Any serious shock to confidence can cause sales by those speculators who have always hoped to get out before the final collapse. But after all possible gains from rising prices have been reaped, I'm the one who can time the market. It's called timing the market. You're going to be the one that can tell just before it hits that peak. That's when you're going to get out. Their pessimism will infect those simpler souls who had thought the market might go up forever, but who will now change their minds and sell. So he's setting up kind of, who are those simpler souls? Now, one thing that bothers me about Galbraith a little bit is that he does occasionally fall into thinking that the raggedy multitudes were coming into the market, and that's what kind of ruined things for us people who know what's going on. George, did you get the feeling that Galbraith occasionally was thinking of himself as being one of the elite, certainly the educated people who understand the market, know what to do? Their plans were being upset by raggedy multitudes coming in who were just, or is he respecting the speculators? Well, is he?
I would say that John Kenneth Galbraith only thought of himself as an elitist.
Yeah, that's right. And a telltale detail about that is when he talks about, when his son talks about calling John Kenneth Galbraith in 1987 when the market crashed. And he says to his dad, "Are you okay? Are you okay?" And his dad says, "I'm fine. I sold out 3 weeks ago." And then his dad says, "But not so for your mother. She's got some Edison here that she's never going to sell, that her family bought for $1. Well, when did her family buy it for $1? At the end of the crash in the market. You know, when respected companies like Edison had gone down to $1, that's when Galbraith's, the younger Galbraith's mother had bought that. So we're talking about kind of a blue blood, kind of elite, not maybe not blue blood, but at an elite group of successful investors who know when to get out. Now, did it turn out to be true in these two chapters? We're looking at two chapters here called The Great Crash and then Things Worsen. And then we're going to talk about aftermath next week. So it's divided into things become more serious. So by the time we get to page 107, he's finished his chapter called The Crash. And many people thought the crash was over because it had had a serious downturn. But then what happened? It went down again. And so the way he tells the story in these two chapters is one plunge, then sort of a plateau or wavering time. Whenever, oh man, that's over. Now I can jump back in. And it's going to go up from here because it came down so far. My gosh, it came down 20%. But it's going to go down 90%. It's going to go down to 90%. I mean, just what Sue cited yesterday of something going from $30,000 to $3,000. I mean, just it's not like a little hiccup. It's the whole caboodle that went all the way down for reasons that just have yet to be explained. There'll be plenty of explanations for that as an after the fact. Oh, well, oil prices went down because we have a pandemic. Nobody's driving their cars anymore. Who's using oil? And oil prices plunged all over the world. Rachel Maddow wrote a book called Blowout about what's happening in oil prices and looking at all the things that are affecting oil prices. So bonds and oil prices are going to be no good, even though the company that's holding those bonds has to pay their bonds. They don't have to pay their stockholders unless they have profits, but they have to pay their bonds. So how could the bond go down? Well, those are the simple questions that people ask. So it's the double whammy that came along here. I must say that when the crash was coming last April, I did sell a lot of whatever stock holdings that I have. I pretty much almost completely, about halfway cashed out. And so I'm going to have a big capital gains hit this coming year in my taxes, but that's all right with me because I did get back in. I did rethink it in the weeks following this and saw what I did think the pandemic meant and what I did think the economy meant, thinking more and talking to my family. I did get back in of what I had gotten out of close to where I had sold it. So I reversed what I did. But of course, now in a way, I pay both prices. I pay the big capital gains that are coming because it's not in a tax deferred account. I pay the big capital gains. And then I don't get the safety that I was trying to buy by going into cash. Now, which investor that we've mentioned already was holding an unbelievable load of cash at the beginning of the pandemic? Warren Buffett, who I just mentioned, was criticized the whole long year for sitting on cash. Why is he?
That's because he couldn't find anything to buy.
That's what he said, right? Absolutely. He couldn't find anything worth buying. Well, then the individual investor like me is asking me, well, if he can't find anything to buy, why do I think I know what I should buy? So things about this are a mystery. And that's why it's very interesting to read this book. Now, those of you who are investors and have read I assume many of you have read other books about investing. What did this add to your understanding if you've already read a good bit about investing and how to properly invest and manage whatever you're working with? For me, it was just a more sophisticated look at some of the things that we wonder or think by common sense, to think about the market in a different way. Do you think so George, you must think there are a lot of people who left the market completely.
Well, I think there were a lot of people that stayed out for a while, and then they realized it was a mistake to stay out because the market was going to rebound, and they got back in, and they They didn't make as much money as they would have made if they just stayed in. But if they had significant enough holdings, if they didn't stay out the whole time, if they stayed out long enough, that the market essentially fully recovered. You know,
All right.
there doesn't seem to me, you know, it's all a case of what your situation and financial situation is. I have one son who said, "Wow, did I make a hit on my 401k and IRA take a big hit?" And I asked him if he had anything in cash. He said, "Well, yeah, I didn't sell much, but boy, I sure took it down." I said, "If you got any cash, put it in the market. It's going to come up." And you know, month or two back, you know, well, how'd you end up the year? Well, I'm ahead quite a bit. Okay. That's
Do you have a certain amount of, if the stock market is not a mirror of the economy that already exists, if Galbraith has sort of let go of that, then what is it that's going to continue to be the basis for the American stock market to continue doing what it's been doing? And one of the questions that you can ask is,
well, you have to separate the market, Linda, into you know, it does reflect the American economy at the fundamentals level, but not all the investors pay attention to fundamentals. I mean, there is absolutely zero fundamental case for putting a buck into Tesla, but obviously a lot of people want to own Tesla. A lot of people have made a ton of money in Tesla, but you know, on the basis of fundamentals, good grief, it is you might as well play the crap tables as to put money into Tesla, or but you know, but on the fundamentals level, you know, does it, you know, the market does reflect, but not all investors in the stock market pay attention to fundamentals.
all
I
right,
mean, look what happened to GameStop. Holy smokes.
that, you can say that again. Now that is where the opportunities come from, according to Warren Buffett, where the corrective is the people who look at fundamentals and how their money moves in the market is going to be a corrective to all those people who think, well, you can never lose $1 on Tesla, because Tesla is going to be the wave of the future. Just like my poor dad saying, well, airlines are the wave of the future, so I'm going to put some money in an airline. And it matters which one, and it matters why. And Warren Buffett wrote a famous article in Fortune magazine in about the 80s or so, explaining why nobody had ever really made any money in the airline stocks.
Nobody has ever made any money in the automotive business either. But that doesn't mean it's not an individual investment that people can make money on. The automotive industry, like the airline industry, is a capital intensive business that just drains capital from our society. But you know, we got to have transportation to support the current economy. So we keep pouring capital in, and the society loses money on it. But you know, that's the way it is. You know, and besides, people want a new Cadillac in the driveway.
Okay, people want a new Cadillac.
Or maybe not a Cadillac anymore. Maybe it's a Toyota. For the crowd in Hasp, it's probably a hybrid Toyota. Mine happens to be a big Mercedes. But you know, I'm maybe not the typical Hasp member.
You don't have a Tesla?
Who wants to drive a Prius?
Why don't you have a Tesla by now, George?
Because I can't fit in the dumb thing. It's too small.
All right. So any marketplace, whether it's a bazaar in a foreign country where you're shopping for a scarf to take home for a friend, or some kind of market in a country where you wouldn't want to trust that market as far as you could see it, like in a foreign country that they're not a democracy. They don't have a Congress setting the rules. They're ruled by tyrants and oligarchs, and who knows who's manipulating the markets. The American market is at least going to be trusted around the world as having a rationale and a free country behind it and a democracy in which our Congress does control the market so that it stays regulated, so that the buys and sells are enforced and the reporting is correct and the accounting is not completely fraudulent, and those Puritan values of honesty and logic and regularity are trusted around the world. Now, the New York Stock Exchange spends a lot of money on public relations. They want a good reputation with the public. And is it true that Congress has the power to regulate the stock exchange? Well, it is true that Article 2 of the Constitution gives the Congress the full right to regulate trade and interstate commerce. And this is certainly interstate and international, if anything is. So yes, Congress does have the right to set up regulations. But the amount of money that passes through the stock exchanges is just astronomical. And is that a reason to trust it? Well, we all know that if we wanted to bet on the Super Bowl last week, we were probably going to be out of luck because we couldn't even get our bet in that we wanted to know what to do. And how would we really know through what agency we're betting this money? And if we send in our $100 or our $200 on our bet, that we're really going to be paid what we're supposed to get paid when we win. Can you trust that? So the trustworthiness of the stock exchange, at least historically, has been there, so that not only money from the United States, but money from all over the world comes into this stock market. Is that a safety feature or perhaps a risk feature, do you think? Well, I think from what George just said, there's enough money just in the United States waiting to go into the stock market. That's cash that can't be, cash that has to be invested, let alone a Russian oligarch trying to put his money in here, an Arabian sultan or, one of the Arabian princes putting some of his fortune in the American stock market. Is that a safety feature or is that a danger feature? Galbraith reflects so many different aspects of the market that he is showing not so much those questions which are extraneous, to this book, but the nature of a market and the nature of a bubble. He keeps using the word bubble. Now, do you think there's a difference between a bubble, which is like GameStop is a bubble, and a boom market, like boom and bust? When we use the phrases boom and bust, we sort of mean the whole economy or the whole market as a whole is in a boom or bust, versus individual stocks that tend to be overpriced or go into a bubble mode. What the investor is looking for is a stock that's underpriced, right? Well, how can we say that a stock is underpriced? It's being undervalued. This raises a whole question of your philosophy of what a market is, which is what Galbraith as an economist is, is dealing with. And one of the functions of the stock market is to discover price and then record it. Now let's see, let me go down to the next slide here. First of all, the stock market is fast. We noticed that the telegraph was already serving the markets in the 1920s, so that a telegraph-based ticker could be found in many places, even in small towns, for people to follow the market day by day and find out what the price was at the moment. And now that has been super sophisticated so that we can tell within seconds what the market is. If we go into our stock accounts and keep refresh, you can drive yourself crazy watching the price move by the second or by the minute. Now, do people outside of the stock market already understand what a market is? I think, yes, in any culture that has developed a money economy with a stable currency, there will develop markets like the ones that we can just mention here. How many of you have ever been to an auction of anything? Cars, houses, flea market auction, any kind of an auction. We all kind of understand that the auction is something very old, goes, way, way back to have an auction. Just a village square was a marketplace in many of the early towns where anybody who had something to sell would come down to the village square with their eggs or their chickens or their produce and whatever else they had to sell. And when you travel in foreign places, you can find great big marketplaces where a lot of stuff is for sale, a lot of it overpriced, and sometimes things that to you are great value. Flea markets, haggling markets. A sheriff's sale refers to property the sheriff has seized from a foreclosure or because of a theft or because it's lost and found, and sells it off, and then that money is distributed to creditors. An estate sale. Well, estate sales have taken place for hundreds of years, even before the stock market. The New York stock market was established in 1817. But before that, you had estate sales. When someone died, the estate would be sold because there were heirs and creditors who both had to be satisfied. When something is on sale, a discount, a giveaway, a clearance, a fire sale, we are surrounded by marketing from day to night as American citizens. Every minute of the day, we're being sold something. How many of you have found a way to click through the ads when you're watching a program you want to see, and you have finally found a way to get rid of all the ads and not have to watch all that? But we're used to saying no a couple thousand times a day to things that are being marketed to us. After newsprint came in and daily newspapers that cost enough for the ordinary person to buy became common after about 1840. By 1840, there were penny newspapers that could be printed quickly enough to have daily or weekly news. And classified newspapers, posted bulletins, flyers, the Craigslist type of thing in print. And then, of course, now many, many ways of selling online. How many people have bought or sold something online, like household goods or a piece of furniture or a piece of art or something, piece of decoration or something? How many of you have bought and sold in secondhand markets in your life? Like you're a graduate student and you need to furnish an apartment on $300. So you're going to go into the newspaper or to secondhand markets, okay? How many of you enjoy that type of buying? I want to see how many souls we have who really enjoy getting. Do you feel like you're getting something for nothing when you go into a secondhand market? You have that thrill of the chase and come home just thinking about it over and over again. Boy, I got this for only $3. How many of you think this is a Dutch characteristic? Hands up. How many of you think it's just a thinking person's characteristic? You're always looking for a value. You're looking for a value because you realize what your money is for. It's buying power. How many of you had sold something on Craigslist? I want to hear a story or two about some of the most unbelievable things that you managed to sell on Craigslist. Okay, I'll start off. When I came back to Illinois, having to sell off a whole property in the mid-90s, there was a greenhouse on this property. Great big house-size glass greenhouse, and I thought, I'd like to sell that thing. I didn't want to hire somebody to come and take it down, and I felt the property wasn't going to properly sell with that greenhouse on there. It was irrelevant. I put the greenhouse in the Chicago Tribune Classified, and I sold it for $3,000. And I sold it. I managed to snag a guy who owned a glass company, and he came out with his truck and at no cost to me dismantled the entire thing. I said, you have to leave the site clean and I'll sell it to you for that. He was thrilled. I said, what are you going to do with it? And he said, I'm going to put it up over my swimming pool. And I said, does your wife know about this? kind of said no. I said, well, remember, there is no refund. This is a final sale. So something as odd as a greenhouse can sell in the classified. And by golly, of all the readers of the Chicago Tribune, you can find somebody who needs that greenhouse and he's willing to pay your price for it. Was it fair that I chose that price? Could I have gotten more for it? Who knows? I don't know. Somebody said to me, well, he was probably going to grow marijuana in it. That's why he wanted the greenhouse. I have nothing to do with the drug trade. I don't know what anybody wants a greenhouse for. How do we know what is a fair price? It's a fair price at that moment and under those circumstances. There is no fair price in an abstract way. That's why at any given moment, you have to discover the price in the marketplace. Now, when we say fair market value for a piece of real estate, what do we mean? Well, we usually mean a broker went through some comparables and made adjustments and came up with a fair market value, or a broker's professional opinion, which is an educated guess for what it will go for in the marketplace. So when we deal with real things in the real world, we know that price is quite variable according to the moment, according to all the factors that play into that. So what makes it a fair price? Well, the classic definition is a willing buyer and a willing seller. And that there are, congressional rules against fraud, actually telling lies, misleading the customer, making false statements about the thing that you're selling, or other types of fraud, some other type of cheating about the price. How many of you have worked in retail where it was your job to sell something and you had to come up with whatever would be convincing to the buyer that would get them to buy that thing, whether you're at the jewelry counter or you're working in a dress shop or you're in any other way selling something? And what do we learn by being the person who's responsible for selling something and being good citizens? We do not want to cheat someone. We do not want to deliberately talk someone into doing something that we know they shouldn't do. But that's very difficult to judge. For example, when I was in this process of selling this house and scraping by on a very low budget until I received a certain settlement, I was driving around the town on a Sunday afternoon, and I was eyeing the various garage sales. It's 4:30 in the afternoon. It's starting to rain. So this is the very end of the sale. And here in a driveway of a house rolled up, I saw a beautiful hooked rug, about 8 by 10. It was vintage, but not antique. And it really was very nice looking. The top was a little worn. The bottom of it looked beautiful. The other side of the rug was beautiful. I asked myself, what would I pay for this? And if it's no good, I'm not going to cry about it. You don't really know. So I thought, okay, $40. I would go $40 on this. And I offered her $40 for this 8 by 10 rug, and she took it. She was happy. This was the end of the day for her. She'd gotten rid of anything in the house. I took the rug home, and the binding could be reversed. I could just fold it back the other way and by hand sew it all the way around, so that now you're actually looking at the bottom of the rug, in which the design was perfect and it had no wear and tear. It was just beautiful. That was successful. I knew I could try that, but if it didn't work, I'd throw away the rug and not cry about my $40. So it turns out well. A couple of years go by. I enjoy the rug in my bedroom for 2 or 3 years. It's lovely. Now I'm ready to move and I'm selling my stuff. And I put it in the newspaper for a comparable price that I think I would pay for this rug that looked this way in a secondhand store. And I decided to ask $400 for it. And a lady came. She called about it. I explained what I had done. I did not say it was antique because it wasn't antique. I told her I had reversed the binding so that you're actually looking at the bottom, and she would have to come and see it to see if it was suitable. So she came out, like me, she really loved the way it looked, and she paid me the $400. Now, did I do anything wrong in getting something for 40 and selling it for 400? Were both of those fair prices under the circumstances that applied when that took place? How many of you think circumstances determined what those prices were? The fact it was raining, the sale was over, the woman was completely clearing everything out. Anything she got would be fine to her, because otherwise she has to give it away. Another example. I did not own a car at any time in college. My father had a car in college between 1930 and 34. He had a car because his father had one to let him have. I didn't have a car in college. I didn't have a car in graduate school, and I didn't have a car my first year teaching because I couldn't afford it. I owed my dad $1,000, and it was important to pay that back. So I didn't have a car that year. I went around with friends who had cars. First time I bought a car was in Holland, Michigan, when I was getting ready to go back to that teaching job for the second time. And my dad helped me buy it for $600 in Holland because he knew one of the dealers here that was friendly to ministers. Remember, in Holland, if you're friendly to ministers, you'll go broke. If you give all the ministers a really good deal, you won't be in business anymore. But he got a wonderful deal on this, and I drove my Chevy down there, and I drove it for a year. Now I was going back to graduate school. I paid $600 for it in Holland, Michigan. And down in Ohio, I could advertise it truthfully as a car driven only to school and to church by a teacher. And a man came and paid me $900 for that car. So not only did my dad get a good deal, not only was it a truly good car, but it was worth $900 to that man who willingly paid, willing buyer and willing seller, and no lies told about the car. And everything else depends on circumstances. But one of my husband's favorite stories about me was he knew that I had sold my first car for more than I paid for it. Now, are those unfair prices? I'm just telling these anecdotes because price depends upon the moment and the circumstances. Now, does that apply in the stock market? Well, yes, but because in the stock market, you have a tremendous number of buyers and sellers. But sometimes you don't have a tremendous number of buyers and sellers. It all depends, as George Borkter would say, on how many buyers you have and how many sellers you have. If you don't have enough sellers, then you're going to have big air pockets in the market as it drops down to the next price down. You don't have a line of people like a crowd out in the street waiting to buy that thing. So it all depends on what we call liquidity. Are there enough buyers and sellers in the market to make the prices go smoothly up and down? Or do you have so few buyers that all of a sudden it's a desert out there and you'll be lucky to get anybody to pay that price? There's one example that Galbraith gives in the book of the little messenger boy who buys a whole bunch of stock for $1. He just puts in a bid for $1 a share as a joke, and he gets it. How many of you at an auction have put in just a ridiculously low price and you got it? Okay, so we have many kinds of markets that people are accustomed to, and we're all accustomed to the psychology of ethical buying and selling. Everybody's ethical, willing buyer, willing seller, proper information about the item, and no lies told.
Linda?
Yeah.
Getting to that point, one of the things that struck me in the reading was the whole notion of you don't know what you don't know. And a moment ago, you were talking about willing buyer and seller, but the assumption is that they both know enough that they're making a good purchase that won't have any repercussions later. Whereas talking about the Oracle of Omaha in the reading, there seemed to be an oracle on every street corner or one per town that thought he or she was knowledgeable, but really they didn't know what they didn't know. So in the stock market, where you have people that really don't know what they're doing, either the buyers or the sellers, then what responsibility does the market have, or the regulators have, to ensure that that whole premise of a fair with an honest buyer and an honest seller, that transaction will work and sustain itself?
Okay, profound question, because we have and do and will run into that as the Congress tries to determine from time to time when bad things happen. Congress will come in and have investigations and try to determine whether there needs to be new regulation to prohibit certain things from happening. I think one thing that has already happened from that is standard rules about what a company must disclose about itself in order to even list on the stock exchange. You know, they have to have prospectus, and they have to have annual reports, and they have to, you know, the degree of reporting that companies need to do and disclosure that they need to do in order to even be able to be listed on the stock exchange. But you're saying, is there an argument for, so how could any congressional action solve the problem that sometimes everybody wants to sell and nobody wants to buy, so the market is going to plunge?
Right, and history repeats itself. It's not just the market. If you look at, we were talking earlier about gambling, online gambling, and just like in the book, the market, those that were creating the various trusts were looking for validators. They went to professors like you who are willing to go on record. But if you look at some of the ads during the Super Bowl, or recently when you replace the political ads with the gambling ads, they're having people come on that are spokespeople to validate, to provide some element of trust, because like pitching anything else, you've got someone who you respect who's now validating online gambling. So you're looking for somewhere that you feel like you can trust them and move forward in something you know nothing about. Getting back to, you don't know what you don't know. Right. About what you're getting into with online gambling. But if someone you respect says it's okay, then you don't know what you don't know, and they may not even know, but they're lending their name to it, which is much like what was happening in the book.
Yes, exactly. And I think Galbraith has a lot to say about what he calls incantation, like hocus pocus type constant reassurances. Everything's fine. The fundamentals are there. Yes, we had a hiccup in the market, but the fundamentals are there. And then, you know, apropos of that, we're not at the end of the book yet, but the very last sentence of this book, the very last sentence of the whole book is about people who should know better not saying anything. And that is a root problem. Now, as throughout history, the last few sentences of the book, now as throughout history, financial capacity and political perspicacity, political balance, are inversely correlated. Long-run salvation by men of business has never been highly regarded if it means disturbance of orderly life and convenience in the present. So inaction will be advocated in the present, even though it means deep trouble in the future. In other words, the tendency to say everything's fine, we don't need to do anything, the fundamentals are fine. Here, at least equally with communism, he says in 1955, lies the threat to capitalism. It is what causes men who know that things are going quite wrong to say that things are fundamentally sound. And that's pointing at a main theme, wouldn't you say, of Galbraith in this book, that people, men who should have known better, were saying that things were fundamentally sound, either because those men were ignorant, or as he implies, they knew better, and maybe they were acting in their own interest in the market, but they would say the opposite of what they were doing in the market. Yeah, he's got many, many examples of that. And he's particularly hard on some of the leading academic voices of today, isn't he? Just in the Harvard Economic Society and things like that, we'll run into as supposedly authoritative spokespeople for the market who should have known what they were doing. as the stock market develops, we develop both terminology and casual sayings that show the sophistication of our financial structures and the many, many kinds of buying and selling that we do. King's X is the old idea that a king can cancel anything he wants. But other than that, laws enforce contracts and collections with exceptions. A foreclosure, we kind of know what that is, but it can relate to so many things. It's an unwilling seller, and a foreclosure is an unwilling seller. That's why when you do a broker's professional opinion in real estate, you're not supposed to include foreclosures in that, because that'll lower the price, but it's a sale that was an unwilling seller if it was foreclosed. Good as gold, we know that phrase. Up until the late 1800s, the United States tried to maintain a gold reserve that was sufficient to cover all of its currency, but that became hopeless after that time because of the growth of the economy. Now, besides buying and sell stocks themselves, we have stock options to either buy or sell. That whole layer of the next layer of marketing, that is just an option to buy or sell. You pay a fraction of the price for an option that you would pay for the price itself, but entitles you to buy it if you want to at a later point. And the whole futures market is, well, the stock market itself is related to what people think the price is going to do in the future. And then the number of auctions goes way, way, way back, of course, used to buy or sell real estate, cotton, cattle, slaves, sheriff sale. The auction is a right now sale. You show up with your money, you have to take it right away. You can't take time to ask somebody else or pass it by your board. You pay right now. And that's why the auction price is going to be less than a price in a store or in a retail market. Here's a piece of paper that looks like money, doesn't it? It's all decked out to look like money. And this is what it looked like to have an investment trust. And we know from Galbraith's discussion what happened to the investment trusts. They went bust even more than the stocks themselves, because they were totally just empty houses piled on top of one another through leverage. So it's as insecure as it could possibly be. And yet look at all the decoration and fine printing and architecture and numbers on here to make it look official and trustworthy. Now, the one thing that he points out, that this is getting a little bit ahead of us, but while we're talking about volatility and prices, when I showed this picture last week, this was a pandemonium in the streets as people rushing back and forth. And this is probably more related to a closed bank where people are trying to get their money out. One of the results of the stock market crash is that ordinary banks, even the state bank in Holland, Michigan, closed during the crash. You couldn't go there and write a check and get your own money out of the bank. Not even Hope College could go and get the money to pay its professors and so forth. So that is one element that apparently has been solved by the Congress since then, because now we have the FDIC, the Federal Deposit Insurance Corporation, which insures with federal money your bank account up to the size of, does anybody know, up to what number is your bank account insured by the federal government? The bank can never have to close. You will always be able to get your money.
250,000 per person.
Thank you. It used to be 100,000. So up to 250,000, your deposit, your bank deposit is insured. Does that mean the money you have in the stock market is insured? Your account with your broker is insured?
I think it's not per person, but per account.
Per account, okay, all right. Now, since only 1 out of 20 households had any connection with the stock market in 1929, if the banks hadn't closed, then there wouldn't have been the panic effect on just ordinary working class people who couldn't, they had their paycheck, but they couldn't cash it. Or the company couldn't issue their paycheck because they actually didn't have their own account open. Money just froze. The money supply froze at the bank level. And that is what I believe, and correct me if you know better, but I believe that the FDIC now guarantees that that particular disastrous effect on ordinary people would not happen again today. Let's talk about mobs. We've seen a little bit of mobs lately and a little bit of attention to mobs and what they can do. So let's do a hypothetical. Could a future angry mob storm a stock exchange in New York and say, this place is just making rich people richer and poor people poorer, and we're going to shut it down? If they were angry at rich people getting richer and think the stock market is only for the rich to exploit the working man, would it be conceivable that a stock exchange could be shut down by mob action? Would it have to be a massive cyber attack and not attacking a specific physical bricks and mortar place? Because today, what is the stock market? Today, the stock market is 90% conducted online, right? We had betting sites crash in the Super Bowl as betting tripled on the game. So good luck betting on the Super Bowl next year. But what protects the stock market from going dead from a massive cyber emergency and completely messing with the records that this is all built on? Just this unbelievably huge pyramid of records that we need in order to keep an orderly market going. Do you think people in the government and in think tanks are asking these questions today and trying to come up with answers to them? Well, I will tell you that a classmate of mine, Tom Dykstra, had a degree in, literature or philosophy or something. He didn't major in business, but he did get a job with a bank after graduating from Hope. And he went on up and up and up and up and up. He was just a smart guy who knew how to think about these problems. And he went very high up in Wells Fargo's system of knowing the security systems and knowing all of the just enormous systems that banks have created to try to put layers of security in place around their record keeping. And so you never know what your liberal arts degree is going to do for you or where you're going to end up. Because here's Tom Dykstra doing this, he's retired now, doing this arcane job of helping Wells Fargo keep their records safe. Now, have you been thinking about crowds lately? We're thinking about crowd psychology. I mentioned the book last week, Extraordinary Popular Delusions and the Madness of Crowds. How many have you ever heard of tulip mania? It happened in the Netherlands. It was a massive crowd thing about tulips. The price was just put up and up and up so that people were just giving up everything else in order to buy or sell a single tulip bulb. What are the characteristics of a crowd psychology? Do you ever go home and wonder, all these people who came to the Capitol with crutches and baseball bats and homemade napalm bombs, what do they do at home on an ordinary day? Are these real people with real lives? Where did they come from and what do they do in their daily lives? Who are they? What are they doing? We see crowd psychology like we very seldom see it, except on a football, field when our team has won. But the excitement is just electric and amazing, and mob psychology is amazing. So think about crowd mentality, the herd mentality. Well, everybody's doing it, so it must be safe. Now, we think that way in investments, like George was just saying. How do we know who to listen to? Well, we pick out a guru. Is it Susie Orman? Is it Warren Buffett? Or is it some ridiculous person? Is it the prosperity gospel? Did somebody get up and say, hey, the righteous man, whatever he doeth, shall prosper? Says so in the Bible, whatever he doeth. He's like a tree planted by the rivers of water that bringeth forth his fruit in his season. His leaf also shall not wither, and whatsoever he doeth shall prosper. Do we go with that psychology and apply it to our nest egg? Well, not if we've lived a normal human life. We know the ups and downs and how often good people don't prosper and the wrong ones do. But the prosperity gospel is a real thing in our culture. There are people who invest and do things with their money, believing that they can't fail because of some superstition, like I'm a believer, therefore I'm going to prosper. Who do we pick out who's going to tell us what to do? So that's a kind of crowd psychology too. So peaceful protest has a crowd psychology to it. Angry protest also gets that way. Do all crowds require police patrol? Well, you see a policeman right here in the picture, indicating that these people are walking, not running. They don't seem to be screaming. They all have their hats on. They're dressed up. They're carrying a caution sign, but they don't seem to be a mob as we think of a mob like we saw in the Capitol. But do all crowds require police patrol? Yes. Do all crowds like this require a permit in the United States? Yes. Is right of assembly one of our civil rights essential as a civil right? I believe yes, but guaranteed only within limits. And give historic examples of famous crowds. Well, the storming of the Bastille. And somebody called the assault on the Capitol medieval in character, a battering ram. One of the senators described the sound of bashing the door as a battering ram. That's medieval warfare. A catapult, things thrown, and pressure of a mob against a gate. The gates are just tremendous. Gates can be broken down by the pressure of an entire mob all pushing forward. No police line can stand before that. So we saw some of the elements of mob psychology that are part of our historical memory, but we don't see them that often in public life in the United States. Over against that disorder, we do have the picture of order about a stock market. And as I read this book, I began to have really respect for what a stock market is in our country as an ideal, and that needs to be there. Financial integrity of a free and law-abiding people. So the purpose of a stock market is, one, to establish regular market with credibility to a discerning, educated public and a steady currency. Both of those are elements that are there in the market, even if it's not everybody. Discover prices. They're not set by any outside force. They're not set ahead of time. They're not dictated by anyone. They're not set by the president or the Congress or anybody. Discover prices by exposure of bids and asks, efficiently paired, not hindered by any force or bias built in or hidden in the system for fraud. Now that, what I just said, is part of what we need to protect. It's part of what we mean when we say free market. The ability to record transactions as legally binding. We don't think about this as a characteristic of a free society, but a free society, in order to protect the people, must have records of transactions and have them be able to be legally binding. Otherwise, there's always the king's ex. There's always the person who came, well, I know I offered you $40 for that a week ago and you sold it to me, but now I don't want to pay you. Now I want to know if you'll take 25. That kind of thing can't happen. It's legally binding what you agreed to on the day of the sale. And the will of the people to obey all state and federal laws that are related, even if some of them don't work correctly or create problems along the way. Transparency and accountability, which we expect in all of our transactions, controlled by Congress or subject to the law. And that the stock markets have a sincere intention of complying with all rules of banks and brokerage houses and will employ a reliable workforce. Look at all of these elements of what we believe in when we believe in law and order as necessary to a free people.
Linda, I look at that second bullet point and I am struck by the one thing in there, coming from a family of teachers, educators, is the educated public. And I look at that, maybe because I'm biased, as maybe so important here. And I also, it reflects on what we're seeing in our society right now with our future with democracy, but I see it also as an underlying major part of the stock market and what we're discussing today. And what, as I'm reading here, Gilbert, this keeps coming back, what is considered educated as far as the public is concerned, and your responsibility or personal responsibility.
Right. And when we say an educated public, of course, anybody who's a teacher has thought really often about what does that mean? And I would say, does it mean that only people with college educations should get involved in the stock market? I certainly don't believe that. I do not believe that. What is the educated public? Well, I'm thinking about my grandfather Verdine, who had only an 8th grade education. And he was born in about the 1880s. He would sit, I remember seeing him keeping his account books. So he wasn't somebody who couldn't add and subtract and multiply and divide. And running a farm was a pretty complicated business, if you ask me. You had employees, you had to keep equipment, you had to anticipate and decide what were your choices of what you were going to plant next year and why you would plant this crop or that crop, and what the whole process would be of how to carry that out through many stages and using that. And he would read the farm brochures that came from the agriculture department, and they talked about things like crop rotation and how to plow a hillside, things like that. The farmer is an educated person when he succeeds in his farm. He succeeds because he has, in a way, more organization and education than the farmer next door. And that wasn't because he went to school, but he emphasized education and he knew how to do the math.
Exactly.
He knew how to do the math. And I'm sure he knew percentages. If you asked him what's 2% of 100, he wasn't confused about what the answer was. But my exposure to a populace that was so lacking in financial education was the college teaching I did down on the east side of Cincinnati in a rural area there, which has a tremendous history with a long hill country, very anti-reading, anti-education, anti-government attitude. And they wouldn't be able to, I'm not going to say way. I mean, I was teaching the cream of the crop who wanted to go to college. So I had people who were the self-selecting ones who were looking for an education. But I certainly ran into young people who had not been taught how a percentage works. You could ask, what is 20% of 100? And they'd go, $2? No. Who taught them 8th grade math? I mean, at what level did you and I learn this in school? Well, I mean, hopefully in junior high and maybe before that. And I taught a class at one point for the philosophy department called Contemporary Moral Issues. And I went through the textbook and I didn't like some of the things they had. They weren't that related to my students. So I introduced a whole chapter on bankruptcy as a contemporary moral issue. And we discussed what the bankruptcy laws are, who they're intended for, why they are merciful, why it's not dishonorable to take a bankruptcy if it's needed, and how that works. So I could introduce them in their terms, probably with people they knew, about what it is and how it works, and begin to give a financial education at the bottom of the heap there, where this is frequently a second chance for someone. One time, I asked a class of mine how many of them knew someone who had ever lived in their car. I was stunned by how many hands I saw. It's just, when I contrast the world I grew up in grade school and junior high in Holland, Michigan, There were poor people here. You were going to school with some people who didn't have very much. But the school system came through with teachers who would give you what you needed to have to understand. And didn't we learn math through story problems? A farmer has a field. He da 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 da. You know, specific examples of times when you would have to take some numbers and manipulate them to get the answer. And it was very, very discouraging to see how unable some of my students were. At Claremont College as a whole, in the state of Ohio as a whole, 40% of college freshmen need remedial math at college level. And so the math teachers in the department of my two-year school were finding that they couldn't even begin teaching algebra until they went back and taught what the kids should have learned in 7th and 8th grades at college level, and do hopefully a fast track. And sometimes it could be a fast track to get them up where they needed to be. But even in Michigan, and even national statistics on how many people coming into college need remedial math, and I mean scary remedial math. So underscoring so I'm asking myself, in that mob of people who stormed the Capitol, how many of them could pass a relatively simple math test? How many of them understand how the economy works? If they feel left out and nobody ever helped me, and where is my chance? What do they think? How do they think about that? Why do they have a Confederate flag posted on the back of their cars? As soon as they come to Claremont with a Confederate flag on the back of their car, they soon learn that that's not the cool thing to do at Claremont College, and those Confederate flags will disappear. But they're on there sometimes when they come. So it was, I mean, the cultural difference. I'm not saying Holland has its own public school crisis of integrating now. 70% of Holland public schools, as you know, are Spanish speaking. I'm sorry, they're English speaking now, but they are the Latino population in Holland, which is rapidly becoming, I believe, a very solid and promising middle and upper middle class. I think that Holland has been a ladder and stepping stone in a very important way for many immigrants. But since we see all these immigrants are welcome signs in people's yards, we know that in Holland there is a knowledge that integrating immigrants into our culture is tremendously important, and helping children cross the language barriers, but helping young people cross the math barriers between where a child is and where they need to be in order to be able to participate in the economy as workers and as being productive people, and then being able to use what they produce to save and perhaps themselves directly or indirectly invest. There's so many steps to that.
Linda,
Yes.
I just wanted to alert you that it is 11, and there's a couple of questions in the chat. I don't know
Okay.
where you are specifically in your presentation. The material is so interesting. I'm
We'll
sure.
pick up next week where we left off with this, and let's take the questions for a couple minutes and then conclude today, because this is ongoing. This is why I'm glad we have a couple weeks left to continue.
Yeah, so I'll go ahead and read the first question. And I have somebody in the office, so I hope everybody can hear me. I'm wondering how the military plays a role in the stock market and in turn the economy during either times of war or peace. And then there's two other questions after that.
Well, I'm not sure the military plays a role in the stock market directly. Certainly the amount of buying that the Defense Department does for our total defense budget is a tremendously important element of our economy. Certainly a lot of businesses would go under in a hurry if they didn't have military contracts. But I don't know what the question meant in terms of like, did the question mean the military helping to regulate or patrol the stock market in times of emergency or something like that? I don't know. The military military budgets are huge. And of course, if we're going to have to protect the Capitol as much as we do today, having it surrounded with fences and barbed wire and 25,000 National Guard right now, the states have already spent at least $500,000 in a 6-week period to keep those National Guard there. So if we're going to have a country where that kind of disturbance is going to be more common, then our costs for security are going to go way up, whether it's the military that does it or private security employed by the institutions. You know, we hope and pray that that isn't what's coming, that won't be necessary. But yeah, what was the other question? Did anybody have anything else to contribute on the involvement of the military in the stock market? Okay.
Yes, sorry about that. Again, there's somebody in the office. Education is inherent in existence was just a comment made by someone. So education is inherent in existence. And that must have been a response to something you had said earlier. And then lastly, does the GameStop phenomena show that the market continued manipulation?
The GameStop thing showed that market manipulation continued. Yes.
Yeah.
Yes. I think I read yesterday that in the whole unfolding of the GameStop thing, nobody should be thinking that the hedge funds ended up the victim, because there are plenty of hedge fund managers who know exactly how to short, when to short, how to buy and how to short. And I don't think the GameStoppers, as little amateurs, if they're little amateurs working on their social networks, in the end are not probably going to, as a whole, benefit from this. But I don't know. George, what do you have to say about that? Maybe George is on. Okay, we can take that up again next week.
Yeah, he might have had to jump since it's a little bit after.
Oh,
Anything, does anyone have burning to say before we wrap up?
if you do, bring it next week. And moving ahead now, we're looking at the next 2 chapters for next week, beginning with Aftermath. So we've had the story of the crash now in 2 phases for these 2 chapters, and we start with page 128 for chapter 8 for next week.
Well, thank you so much, Linda. Diana Nelson will be back next week to help moderate, and we just appreciate everything that you do and all your contributions to HASP. So with that, I will go ahead and wrap up the class. Everybody have a wonderful weekend.
Thank you.
Thank you, Linda.